All right, everyone. Well, thank you so much for joining us. I'd like to welcome you to your financial team, and this is a part one of a four-part series presented by Euri Yu, CPA, Donna Lee, Certified Financial Planner, and Sophia Kim Sakamoto, Estate Planning Attorney. This is part one, where we'll be talking about financial advice and guidance through the years, especially when you are maybe single, before marriage, and what to do about taxes, estate planning, and then of course, investments. Let's see, I wanted to go ahead and introduce Euri Yu. She is an accountant, certified public accountant, and she has an office in Fullerton. Donna Lee is a certified financial planner. Her office is in the city of Orange. And me, I'm Sophia Sakamoto, and I'm an estate planning attorney with the firm of Sakamoto and Rallis, and we have an office in Buena Park and Mission Viejo. Euri, can you go on to the next page, please? All right, so if you do have any questions during the presentation, go ahead and submit them in the chat box below. We will try to answer them at the end of the webinar, time permitting. If there is no time, then we'll reach out to you and answer your questions if we can. Just a quick disclaimer that, of course, this is just general information, not legal or tax advice. There's no attorney-client relationship or privilege established by this presentation. It's copyrighted, so if you would like to use it, go ahead and send us some written permission. And of course, this webinar is being recorded. You may have had a pop-up when you first entered that by joining in this presentation, you are consenting to the presentation being recorded. So I will go ahead and throw it out to Euri to get started on the first question. Euri, as an accountant, the question is, my taxes are so simple and I use TurboTax. When should I hire a CPA?
Okay, so if you truly have a very simple return, then TurboTax is probably fine. And I define simple as like having a W-2, maybe a little bit of interest income, but not much else. If you have anything else going on that affects your taxes, like if you own a home with a mortgage, if you do some investing, you have rental properties, or even like a side gig like Lyft or Postmates, then it's probably a good time for you to hire a CPA. What I see with a lot of TurboTax users is that they're really focused on the end result. So if they get a good refund, then they figure their returns are fine. But that could mean that they're missing deductions or making mistakes that could cost them more time and headache to fix later. And tax returns are a lot more than just the amount of refund you're getting. So a lot of the big life changes many people go through are gonna have a significant effect on your taxes, whether it's getting married or having children, changing jobs. These are the things that are going to affect your taxes. Starting a business, that's a big one. There are certain situations where I always recommend hiring a CPA, and that's if you have a rental property. That's an area where I find a lot of mistakes, like with depreciation and stuff like that. Definitely if you own a business, whether it's a sole proprietorship or an LLC or a corporation, I highly do not recommend trying to do a business return on your own because it can be a big headache and a lot of work to fix any mistakes there. And if you have a side gig like, DoorDash, Instacart, anything like that. Also, if you're an employee that receives like stock options or RSUs, oftentimes there are manual adjustments you need to do to the 1099s you receive that are not taken into account when you use software like TurboTax. The other thing is that tax laws are just always changing. Just a couple of years ago, even though it feels like a million years ago, we had the Tax Cuts and Jobs Act, which really affected a lot of W-2 employees because of the change in how they calculate the amount of taxes they withhold from paychecks. And so a lot of people who were used to getting refunds were owing with their tax return. When you work with a professional, they can kind of help you plan for that stuff. And lately, it's been nonstop. I've been doing this for 15 years, and there have been more tax changes in the last 4 months than I ever thought was possible in such a short amount of time. So, not only are we preparing tax returns, but a lot of CPAs have been helping their small business clients apply for these new loans to help keep their businesses running, helping people file for unemployment, helping people track down their stimulus checks. And I know, like, at least for me, I've been trying hard to keep my clients updated on all these changes and how it's going to affect them, because there's a lot of misinformation out there. There's a lot of articles out there about things that are coming. And so it's good to have a relationship with a professional who can keep you updated on the things that are going to affect you and know you and is familiar with your situation and can help you navigate these times.
That's amazing, Euri, because I know with TurboTax, I mean, it's only as good as the information you put in. And if you don't know the information, how are you going to put anything in, right? And so having your valuable financial advice tax-wise would be really important. So thank you for that.
Yeah. The other thing with TurboTax is that, like, the way it works is that it just asks you, like, question after question after question. So by the end of it, people are usually like, I just need to get this thing done.
Mm-hmm.
And so, yeah, it's a lot of work. Okay, so Sophia, what is probate and why should I avoid it?
Yeah, that's a really good question. And I'm sure that you may have heard the term probate and people are confused about what that means. I'm sure that they've heard that probate is bad. Probate is actually just the court process when someone passes away to figure out, what did they own and where does it go and who's in charge to take care of things. People create estate plans and living trusts to avoid going to probate court, because if you have to go to court, it's really stressful. It takes a long time. Probably the average is like 2 years or longer for a probate to finish. And it gets really expensive. And just to give you an example of the cost, if you say everything you owned was like $500,000, just say, and you have one house, it's probably going to be around that much. The fees on that is set by law. It's not, I didn't make it up. It's a percentage of the estate set by statute. And to give you an example, on a $500,000 estate, $13,000 in fees to the administrator, that's the one who's going to handle things, and then $13,000 in fees to the attorney. So $26,000 in fees just right off the bat to handle a probate. Now, for me as the attorney, if I had to do, more extraordinary things like sell a property, talk with, do anything else that's outside of the normal probate process, then, I'm just at an hourly rate and it keeps going up. So you can see that going to court is going to be really expensive. So that's what probate is, just the court process. And to determine, well, will my assets go into court or not? The rule to know is that the threshold in California is $166,250. So if you have assets that are just in your name and you pass, so you don't have anything written down, and the value is over $166,250, it will be in probate, because that asset is a high enough value that the banks are not just going to release it to anybody. The title company and the escrow, they're going to say, well, give me a court order to tell me where this goes or who's in charge. And that court order is probate.
Okay, so how does a mortgage affect probate?
That's a good question too, because people always tell me, okay, I have a house, but I have a mortgage on it. So, and the equity is only like, 50,000. It doesn't matter if your mortgage is on there, because to calculate what goes through probate or not, what's over that $166,000 is the total gross estate value. So it would be the value at the date of death. And to determine that, you can get an appraisal, or usually if you go through the court process, they have a neutral probate referee that the court appoints to figure out that value for you. And so what other things that may not be included in that calculation is if you have joint accounts with someone or if you have beneficiaries on an asset. So a common scenario that I get is married couple, they own a house as joint tenants, which is pretty common, and one person passes away, then it would avoid probate. It automatically goes to the other spouse. But what happens when they're both not here? They both die at the same time, or the second spouse, they forget to do anything and then they pass on. Then the question becomes, well, where does this go? Who's going to manage this? That's when it will be in probate. Assets like bank accounts, assets like life insurance proceeds, retirement accounts. If they have beneficiaries named on them, usually it's like a spouse or kids, then it goes directly to those beneficiaries without going into probate. But for people who are single, maybe they didn't list anybody as their beneficiary, or maybe they listed their parents, but then, at the time the parents are no longer here. Whenever there's a question of like, okay, well, where does this go? If those, where all of those together, not just per account, but all of those assets together of the where does this go kind of question, if they total over 166,000, it will be in probate court. All those assets. If it's less than 166,000, like just say you had a couple bank accounts and it wasn't really that much and you passed, there is an affidavit procedure, which just is like paperwork that you have to submit to the banks or wherever it may be, where you can get the funds. But of course, the banks do, they require you to wait over 40 days before you can access those funds.
Okay.
So I guess the point is probate is to be avoided because it takes a long time, it's very stressful and expensive. And the way to avoid that would be to create an estate plan and a living trust, especially if you have real property, especially if you have children who are minors. And if you're not married, really important for single people, especially if you have like a girlfriend maybe or a boyfriend and you want to, give something to them, write it down. If you don't write it down, nobody will know and the court will decide for you.
Sophia, one thing to keep in mind, probate and estate planning laws, they're governed by state, right? So it's based on the state of residency. So if you moved states and you had a trust in a previous state, you may want to have a new attorney take a look at that. Is that correct?
That is correct. And that's actually a really good point. A lot of people come to me and say, oh, I just moved to California from, whatever state. Do I need to redo my trust? Vice versa, I'm moving to another state. Do I need to redo my trust? You probably should. And the reason why is at least have it updated, because in the trust document, it'll say this trust is governed by the laws of California or wherever you used to live. So if something happens to you and the trust says, okay, those, the laws are governed by, the laws of New York or something, we might have to apply New York laws to this trust, even though you're living in California. You can see how that would kind of conflict with some of the, maybe some of your wishes and then how California default laws are. So definitely get that updated when you're moving from state to state. And that threshold that I talked about, 166,000, that's for California. And I don't know what the threshold is for other states, whether to go through probate or not. I've heard that the probate process in other states are much easier, but
yes,
California is pretty strict and it takes a long time, especially with this COVID situation going on. The courts were closed for a while. It was closed between March and June and just recently opened up. Everything is pretty much, backlogged. And so it's taking a little bit longer. If you had a probate going on, you're stuck. You can't do anything until the court says, okay, now you can start doing things. Meanwhile, with my trust clients, they were able to sell property, do things because they don't rely on the court.
Okay, good information. So what is the difference between a will and a trust? Are they the same or are they two different things?
I get this question, probably it's the number one question I get because people confuse the terms of trust and a will. So a will just means, everything that I own, I give it to X, Y, and Z. And with a trust, you're setting up almost like a separate entity, and you're transferring the title of your assets, not just to your name anymore. It's not just like Sophia and Donna as joint tenants, something like that. It's now going to be Sophia and Donna, trustees of the Sophia and Donna Trust. So you see how I put it in the name of the trust, in that sense that it will avoid probate, because now something happens to me, whatever I wrote in the trust, that's how it goes. And the court doesn't really need to answer those questions about like who's Sophia's heirs, where does this go, how much is in this estate. When you do have an asset that is just in my name, like just in Sophia's name, and then I'm not here and I had nothing written down, well, then the court has a duty to figure out, okay, well, who is Sophia's heirs and how much did she own and who's going to be in charge of her, like to figure things out, who's the point person. So, and that needs to be figured out in court. So when you set up a living trust, your goal is to put most things into the trust to avoid going to probate, and then anything else that you own will be governed by the will. When we do a trust, we typically do a special type of will, which is called a pour over will, that says, okay, if there was something that should be in the trust and for some reason it wasn't, the will says anything else I own, I put it in the trust. So in this case, when you do a trust, the will is just like a backup plan. And maybe you never use that will. Maybe everything's in the trust. But the most important thing to know is that when you do have assets in a trust, it avoids probate, makes the transition a lot smoother. Your family members or whoever is the next trustee in charge can have immediate access to pay the funeral expenses, to pay medical bills, to do whatever they need to do on your behalf. With the will, you probably will be in court and you have to wait a few months until the court says, okay, now you can start acting as Sophia's executor. Okay, now you can do this. The hearing dates are like, 2 to 6, 7 months out, and which is why it's taking such a long time for a probate to complete.
So, okay, I need a will and a trust. I see that LegalZoom does them. Can I just use LegalZoom?
That's a good question. And you know what? Don't get me wrong, LegalZoom can work if you have a very simple estate, things that you own. Just kind of like how you would use TurboTax, but I've seen so many instances where people thought they could do it on their own, and it costs more to try to get it fixed than to just have done it properly in the first place. So, I love LegalZoom because I like to make those fixes, and they cost a lot more than if you would have done it right the first time. And with LegalZoom, they don't give you advice. They won't tell you, okay, just because you're going to give this to your one son and not the other, or you want to do it, give it to your nieces and nephews, it will cause a property tax reassessment. TurboTax, LegalZoom may not tell you those things. They might not tell you, okay, you give, 75% to one kid and 25% to the other. This might cause issues, or you give an advance to one kid during your lifetime and not to the other. Practical considerations I've seen through experience about how to handle these family dynamics. LegalZoom may not tell you those things. And then later on, if you do want to make an amendment or change to these documents, it's going to be a little bit difficult to do, and you may not have the proper guidance. What you don't know, you don't know what you don't know. And the question for you, Donna, would be, and I'm sure you get this a lot, is should I pay off debt, save for a house, or save for retirement? What's the order? What should I do first? Should I do them all at the same time? Like, what do you think about this?
Yeah, that's a great question. And isn't that a universal question for everything, right? Not just finances, even our time, because we all have finite resources. But as it relates to finances, this question is also essentially a million questions, right? Because you can pretty much fill in the blank with any and all of anyone's financial goals. So it would be a lot more efficient if you can first rank your goals in terms of priority. Prioritizing your goals should be a discussion between you and your financial advisor. It's a combination of what's most important to you and any thoughts or comments your advisor may have. Might seem weird to get your advisor's input because they're your goals, they're your wishes and dreams. But it is important to have that discussion because sometimes there are goals that you have that can be achieved using tax advantaged accounts. So therefore you may not need to save as much. Or maybe there's some goals that there are other means to achieve them. So again, you may not need to save as much as you thought. On the other hand, some goals might have certain assumptions built into it, and perhaps those assumptions may not be realistic, and you may end up having to save more than you initially thought. what the goal is, once you have everything prioritized, then the trick is to save for all of them at the same time, but just focus more on the one that is of higher priority. So this is much more efficient than saving for one thing, buying it, and then saving for the next, because you would have missed out on all that time that could have overlapped. Why is that overlap important? There's a concept called compound interest, where interest gains on your principal plus interest. So you're essentially gaining interest on interest. It's the snowball effect. And the longer the time you have to save, the bigger that snowball will grow. And that growth is exponential. So 1 year, 20 years from now it'll grow a lot more than 1 year, 2 years from now. So you want to get that time going. So instead of saving for goal A, reach it in 5 years, and then you start for goal B 5 years later, it's better to save for both A and B at the same time. And then you may reach your goal A in 6 years, 5 years, depending on how much you put extra towards it, but you'll be way ahead when you're done with A and you start to focus on B. You wouldn't be starting from scratch. So long story short, save for all of your goals, but just focus more on the one that is of higher priority.
That's a really valuable advice. And just to add on to that, I think I read somewhere, which kind of stays with me and I think about, is that, say it takes you like 10 years to pay off a debt, and then after 10 years, you're left with zero.
Yes, that's exactly it, because you start off starting from scratch again.
Mm-hmm. And yeah, I mean, time is one thing you can't get back. So I like your strategy about investing in all kind of at the same time. And I guess it is a strategy that probably, you'll need advice from a financial advisor. Okay, which one is better? Should it all be equal? Should more or less? So maybe that's something that a client can talk with you about, strategizing how much to put toward debt, how much to put toward, whatever investments. That's good.
Great.
Okay, but you know what, for those people who are kind of just starting out, maybe they have a lot more student loans or debt than, income that they can put towards savings. And in those situations, maybe they say, like, I don't have enough money for a financial advisor. What would you say to those people with those questions?
That's a great question. So financial advisors are in the business to give financial advice. So what that means is we are the only ones that are able to give financial advice professionally. So you can open an account anywhere, down the street, at your local bank, at Fidelity, at Vanguard, anywhere. But most people don't realize that they cannot provide advice. In fact, they literally cannot legally provide advice to you. So if you had questions like, should I open a retirement account? How should I prioritize my goals? How much could I contribute, or should I contribute? Should I pay off my house? They will not be able to answer you. So if you're starting to have questions about how to manage your finances, then you're looking for advice, and the only ones who could legally provide advice is financial advisors.
Yeah,
preferably a certified financial planner, because they're focusing more on your holistic financial plans. The other thing I'm sorry, let me just quickly note, there's different ways financial advisors get compensated. So it could be through the products that they use, or it could be an hourly rate. So many advisors have a minimum level of assets that they accept for new clients. And if that minimum is more than what you currently have, don't feel dejected. You would just likely fall in the hourly category. Ultimately, it just comes down to value. Do you think that working with a professional will help you reach your goals more efficiently? If they can help you save more or invest wisely, over time, investment gains made, investment advice received, strategies used, and just all the time that they saved you from having to do your own research, do these benefits outpace the cost of hiring an advisor? We all live in the world of Google, where we can find all sorts of information at our fingertips. However, you don't know what you don't know. And if you don't know it, how would you even try to Google it?
Very valuable advice. And I'm sure whatever they pay for financial advising, I'm sure through investments and other valuable, experience and knowledge, they gain it 10 times or even more than that. So that's really good to know. Let me see. Why don't we go on to, Euri, did you want to add something to, I see that you're back on. Do you want to add something regarding savings or paying off debt?
Sure. I always try to, people are always asking, especially if they owe taxes with their return, how do I lower my taxes? And I always tell people the best thing to do is to put money into your retirement accounts. When you can put things in your retirement accounts and get a tax deduction for it, you're basically like getting a break for saving money. So that is the best way to save on taxes, is to maximize the retirement, you know, contributions that you can make, but not only focusing on the tax side of it too. That's a problem that I have, because I'm a tax person. I'm always trying to figure out ways to reduce your taxes now, but that's where a financial advisor is great, because they're looking forward to retirement. So yes, maybe you can save, you know, a little bit now, but think of all the savings you can have in the future if you, you know, do a Roth versus like a traditional IRA or things like that. So this is one of those areas when people start asking me a lot of retirement, you know, questions. I'm always like, you should probably talk to a financial advisor, because they'll really be able to help you plan for the future.
Oh, I love that, because Euri, you're kind of looking at the taxes now. Donna looks in the future, and then the estate planning carries it on to your family and that legacy. Amazing, great. All right, well, let's. I want to talk about, since you mentioned that retirement savings was kind of like the best way to do things. Donna, what are some retirement saving options then?
So there's a lot of different retirement accounts out there, but if we just break it down into two groups, those that are individual retirement accounts and those that have to be set up through your employer. So there's a few commonalities between them. One of the biggest benefits of being considered a retirement account is that they are tax deferred, meaning you do not have to pay any taxes on the account as it is sitting in there and growing. But with every benefit, there is a constraint. And the biggest constraint that you have is that you cannot access the account until you're 59 and a half years old. It's a weird number, but the IRS throws out weird numbers all the time. Just keep in mind that my answer here is really a general overview, and there are many exceptions to everything I say here. So make sure you talk to a CPA or a financial advisor about your particular situation. If you are working, you are able to save into an IRA, individual retirement account, hence individual. So it's just you, has nothing to do with your employer. There are two types of IRAs, traditional and Roth. The main difference between the two are how they are taxed. Traditional IRAs are typically a pre-tax account, meaning whatever you contribute into the account, you will get a deduction for the year. Note that there is an income requirement for the deduction. There's a lot of little asterisks and such, but you will get a deduction for the year. However, when you take the funds out, it will be fully taxed at income tax rates at that time. The Roth IRA is just the opposite. It's a post-tax account where your contributions do not affect your taxes for the year. So it doesn't help on your tax return. However, when it comes time to withdraw, you do not need to pay any tax at all. Imagine all that time compounding. Remember we talked about compound interest? Imagine opening up one of these accounts when you started working at 22, right out of college, and you don't touch it till 60. That's almost 40 years of compounding, and the government doesn't get any piece of that. So depending on your situation, one may be more preferable than another. So this is where you really want to talk to an advisor or a CPA. Moving on to employer plans. Sometimes you'll hear them called group plans. If your employer does not offer a retirement plan, then unfortunately you are only limited to the traditional IRA or the Roth IRA. So there's nothing you can do about that. But for those whose employers do offer a retirement plan, it really just boils down to another plan that you have access to, you can save into. There is another perk with group plans. Your employer can possibly contribute into your 401ks too. It's typically done through a match or a profit sharing bonus. So those are basically contributions into your plan that you didn't make, but it's yours to keep. Again, there's asterisks along the way. Don't get confused by all the numbers and letters. The common ones are 401k, 457b, 403b, 401a. They're all just different sections of the Internal Revenue Code, but they all work sort of similarly. If you have a 401k or one of those letters and numbers, there's typically the option of a traditional version and a Roth version. And kind of parallel to how the IRAs work, the traditional version is pre-tax, while the Roth version is post-tax. Again, depending on your situation, one might be better than the other, and this might change over time. Maybe one is better now, and in 5-10 years, another one is better. So it's important to maintain that relationship with your CPA or financial advisor. So remember, please keep in mind that this is just a general overview to a question that literally we can devote an entire presentation to. So please talk to your financial advisor and or CPA regarding your particular situation. There are just too many nuances to cover in a short five-minute talk. I will note that each type of retirement account has an IRS maximum. So IRAs have their maximum, 401ks have their maximum, 457Bs have their maximum. They all have their own maximums. But there is an IRS maximum, and then there is a maximum you can contribute, which may not necessarily be the same number as the IRS maximum. Okay, but it's best to max out all of your retirement accounts that are available to you. And we're going to talk a little bit more about this, so stay tuned for part 3, I think, where we talk a little bit more about strategies on how we can squeeze more into these accounts. Remember how I said there's an IRS maximum and then there's your maximum. So how can we squeeze it more in? So we'll talk a little bit more about that in future talks.
Okay, I just wanted to throw in that when it comes to Roth 401ks or IRAs versus traditional or regular, tax deductible retirement contributions, I know that a lot of people think, you know what, when I retire, I'm going to be in a lower tax bracket. I'm not going to need to I don't need those tax savings later, but that's not always the case. And tax rates are really low right now. So that means whatever deduction you're getting today is not really worth as much as it will be in the future. So it's another thing to consider when you're choosing between a Roth and something else.
Yeah, that's a great point. I have been doing this for almost 20 years, and I want to say in the beginning when I was working with younger clients, they all told me the same thing, that my rates will be lower when I retire because I'm not going to make all this money. And as they grow and have families and have bonuses and such, they're starting to realize that it truly is, it could be a ticking tax time bomb, possibly.
Yeah, and also when you're retired, you actually usually don't have as many tax deductions as you used to. Like you might not have a mortgage anymore, you don't have kids that you can claim as dependents, and so overall, your taxes become simpler, but not as many deductions.
And one more thing I will add is when people talk about taxes, when you're taking money out of a pre-tax account, retirement account, most of the time they're only thinking about income tax, but it actually affects a lot of taxes, not just income tax. How much your your Medicare premium gets affected even. I mean, who thought of that? So there's a lot of little things that people don't realize that by taking income out of taxable accounts, it's going to affect other costs that they have. So it's a balancing act between the two, not to say one is better than the other. It really just depends on your situation at the time, and very likely it could change 5 years from now. So it's important to stay in touch with your advisor and CPA.
Okay, that's really helpful. We're getting down to the last couple minutes. If you have any questions, please do write them in the chat box and we'll try to address them before we end. But Sophia, moving on to the next topic. So what happens if I buy a house with somebody else?
Yeah, this happens a lot. And people always come to me, maybe they want to buy a house with someone they're engaged with, boyfriend, girlfriend. Maybe they want to buy it with their parents, even though they're married, or at least put parents on title so that they could help with the mortgage. Anytime you have anyone else on title with you, that just means that everyone on title has a share of the liability. So let's talk about liability. You guys are owners of the house. You're on the title, right? Whether you live there or not, you're owners. And say one person gets in a car accident and they are liable for, a lot of damage, they get sued. Well, their name is on this property, and that property is going to be on the hook. Let's see what else. And say you go in together. This happens a lot with a boyfriend and girlfriend, or other type of partner, and you purchase a house and it's joint. Well, when you pass, then it automatically goes to the other person on title. Maybe that's not what you want. Maybe you wanted your half to go to your family instead of the other person. I've seen families each put in money to get like an investment home, and then how is that going to be? What's the liability on that? Who really owns that? Who's claiming that as a personal residence? Does somebody live there? Is it, there's a lot of things to know about that. Also, want to touch on property taxes very quickly, because I get this a lot, where maybe you had it with somebody, but then later on, like, you buy them out, or they want to change the title, so that, okay, now you are the rightful owner. I'm going to give you my half of that property, and you can be the only one on title. Whenever you have a change of ownership on a deed, the property, the county always wants to reassess that property for property tax reasons. So property tax is what you pay the county every year, and it goes by the value of the property. With Prop 13, there's something where if you had an older property, it only increases, that the property taxes only increase just a little bit every year. And so if you had a property from a long time ago, your property taxes are probably really low. Whenever there's a change of ownership, including a death is a change of ownership, the county wants to reassess it for today's value, which means that your property taxes will likely go up. Of course, there's exceptions to that. Parent to child is one big one that gets utilized, but people may not know there's no exceptions between siblings. There's no exceptions between like boyfriend and girlfriend, or boyfriend, whatever your partnership status is. And so that kind of advice you would need to talk with probably an estate planning attorney to figure out ways to minimize those property taxes if there's an exception, and other ways to go about it. In a trust, if someone passed away and there's a distribution where it could cause property tax increases or reassessment, there could be ways to get around that as well. Just want to also touch upon if you had a property with a significant other, and then you do end up getting married, that would be something else to think about how that changes the character of the property, whether you want it to be separate property, whether you want it to be community property. Euri, what about you? Is there any from your tax perspective? I'm sure you get this issue a lot. Is there anything that you'd like to add to this question?
I will say, when you buy a house with someone else that's not your spouse, so someone that files, you don't file a joint return together, there can be complications, especially if there's a mortgage. So if the mortgage interest statement is just issued to one person, and then the other person tries to take the mortgage interest deduction, that is usually an automatic notice from the IRS. They're going to say, where did this interest expense come from? We didn't get anything from the lender, and they're going to add it back and assess you additional tax plus penalties and interest and everything else. So there are things to consider when you own a home with someone else that could affect your taxes. I also see a lot of when people will like sneak someone else onto the deed, and then so maybe a parent will add a child to the deed, and then the child will start taking the tax deductions. And yes, maybe there are certain situations where the child may be able to take the tax deductions, but then you're also creating a gift tax issue there and basis issues. Like it's a lot more complicated than just that. Sophia, maybe you can speak to the whole basis thing, like when you try to just kind of gift property to someone like that.
Mm-hmm. Yeah, and basis, just really quickly, has to do with capital gains taxes, and sometimes there's a benefit of inheriting a property, because the basis or the starting point of where you calculate the capital gains does jump up or step up to the date of death value, so that when you go to sell it later on after death, then your capital gains is a little bit smaller rather than when your mom and dad had purchased it way back in the 1950s 50s or something like that. So sometimes there's a benefit to receiving a property through inheritance rather than a gift or adding them to the title right now. And I'm glad that you touched upon mortgages too, because I see this where people want to remove someone from title or add someone to the title when you have a mortgage. That could cause an acceleration, or it means like triggering, where you have to pay the mortgage balance immediately when the lender finds out. So something like that, anytime there's a change of deed, I always say, get the lender's approval first, because there could be some unintended consequences to the changing title. Okay. Euri, did we have some questions that we can address?
No questions.
Oh, okay.
I guess we covered everything.
Well,
I
then.
think, do you have access to the chat box? Let me see.
Yes, I don't see any questions either.
Oh, okay.
Okay.
All right.
Well, coming to the end of our time, and we want to, we value everyone's time. We respect everyone's time. So thank you for it, and I hope that this was worthwhile for you. Our next event will be part 2 in the series, Financial Advice Throughout the Years. It'll be on Friday, August 21st at 12 p.m. We will still have the 3 of us as panelists, and this time we'll be discussing the next chapter in life. So it could be getting married, having children, buying a house. As always, feel free to invite your friends to join us. We'll post all of our events on Facebook and our website, so please like our Facebook page or check out our website for the event details. You will be receiving a survey shortly. Please respond so we know what we can do to improve our series. Feel free to reach out to us if you have any questions. We hope everyone stays safe and healthy. Have a great day. Thank you.
Thank you, everyone.
Yeah.